So no surprises today. Bank of Canada decided to hold rates steady. I've already made a video on why they're not in a position to lower rates even if they wanted to, and believe me, they do want to, because there's plenty of economic data coming out to suggest the economy is suffering and it needs stimulation from monetary policy. Tiff Macklem is a U of T academic. He has absolutely no real life experience. His first foray into the real life has resulted in the Bank of Canada having losses for the first time ever in history. So now we're going to react to his little update here and give you a no-nonsense guide to what's actually going on and translate this U of T academic speak into regular person speak so that you can make more informed decisions. Without any further ado, let's get into it. Here is Tiff.
This year. Second, growth in the economy looks to be picking up. We expect GDP growth to be solid this
Right, growth is picking up. Unemployment is up. Business insolvencies are up. Expectations for sales are down in the future, and this guy thinks that the economy is picking up. What planet is this guy living on? Right off the bat, this is nuts.
and to strengthen further in 2025. And third, as we consider how much longer to hold the policy rate at the current level, we're looking for evidence that the recent further easing in underlying inflation will be sustained. On a trois grands messages ce matin. Premièrement, la politique monétaire fonctionne.
First, monetary policy is working. Total
I beg to disagree. But I'm sorry, I digress.
consumer price index and core inflation have eased further in recent months.
Right, and what they use to measure those, inflation is the CPI, or as Clyde Do Something put it, CPI index.
And we expect inflation to continue to move closer to the 2% target this year. Second, growth in the economy looks to be picking up.
Right. All the statistics coming out of the economy are saying that no, growth is slowing down. We have an affordability crisis. People can't afford rent. Like what growth is he talking about?
We expect GDP growth to be solid this year and to strengthen further in 2025. Third,
Yeah, see, so right now he's laying the groundwork for the future. So in the future, when things don't pan out as it often does for Tiff Macklem, he's going to come back and say, well, based on our expectations at the time, we wanted the economy to do well, and that's why we did what we did. But big surprise, the economy didn't do well, and of course he's going to point fingers at somebody else, be it Russia, be it Israel, or somebody, or Palestine. That it's because of them that the economy didn't do well, and we just had to not lower rates but continue to increase them. So again, by saying that, he's almost like implying as if they're ready to lower rates anytime right now. The fact of the matter is the world is a shit show right now. There's a lot of war going on and risks are going up. No investor in their right mind would lend out their money at a cheaper rate right now. Risks are only going up and people are going to be asking for a higher rate of return on their money. So there's no way that rates can come down.
evidence that the recent further easing in underlying inflation will be sustained.
So before
Right, so they'll keep adjusting the CPI formula, and that's how they're going to achieve that.
Before taking your questions, let me take a moment to discuss how the economy is evolving. We've revised up our outlook for global growth. U.S. economic growth.
Right, global growth is going to go up. Yeah, we're like on the verge of World War III, and global growth is going to go up. Okay.
Again exceeded our expectations, and while growth is expected to slow later this year, economic activity is
Oh, so it is expected to slow later this year. Pick a side, buddy.
stronger than previously forecast. In Canada, growth stalled in the second half of last year, and the economy moved into excess supply. The labor market also cooled from very overheated levels. With employment growing more slowly than the working age population, the unemployment rate has risen gradually over the last year to 6.1%.
I believe the very last reading for unemployment, it went up a little bit. Obviously, it was a surprise to experts like Tiff Macklem and company, but I believe the latest unemployment numbers are the opposite of what he's talking about.
In March. There are some signs that wage pressures are beginning to ease. Economic growth is forecast to strengthen in 2024. Strong population growth is
It was forecast to strengthen in 2023. Did it?
increasing consumer demand, as well as the supply of workers, and spending by households is forecast to recover through the year.
Spending by households is set to recover through the year. I think the translation of that will be the affordability crisis is going to continue in Canada, and people are going to have to spend way more than they can afford to spend.
Spending by governments also contributes to growth, and U.S. strength supports Canadian exports. Overall, we forecast GDP growth in Canada of 1.5% this year and about 2% in 2025 and 2026.
Right. So that's your typical. That's your typical outlook. Good news is coming, but it's coming later. It's coming 1 or 2 years from now. For now, things are pathetic, but don't worry. Keep your hopes up because things are going to get better. Just hang in there, like that boiling frog analogy.
6. The strengthening economy will gradually absorb excess supply through 2025 and into 2026.
Right. Yeah. This guy can't predict where rates are going to be months from now. Do not trust what he's talking about in the year 2025 or 2026.
CPI inflation eased to 2.8% in February, and price increases are now slowing across
CPI inflation formula has been adjusted.
most major categories. Inflation rates for durable goods, clothing, food, and services, such as recreation and travel, have all declined.
I challenge anybody to go into a grocery store and find this basket of, groceries that supposedly declined. I don't know. Every time I go to the grocery store, I end up spending more and more.
However, shelter cost inflation is still high and remains the biggest contributor to overall inflation.
Okay, here he is trying to shift blame again. Is the real estate that's causing inflation up. Like they're doing their job, but lo and behold, this unexpected, real estate thing is rearing its ugly head, and of course that's the major culprit for Tiff Macklem not lowering rates. Right? He's concerned that real estate is already a problem, and if we lower rates, it might be even more of a problem because it's going to stimulate borrowing and therefore increased prices. This guy is just trying to shift the blame any which way he can, but accept responsibility for his own idiocy, really.
Some other services like restaurant meals also remain persistently high. Looking ahead, we expect core inflation to continue to ease gradually.
Right. Are you is everyone excited about how it's been easing so far? Expect more of the same.
More timely 3-month rates of core inflation fell below 3% in February, suggesting some downward momentum. But with gasoline prices rising, CPI inflation is likely to remain around 3% in coming months.
Yeah, and of course we have the carbon tax kicking in, so that's not going to make prices go any lower.
It's then expected to ease below 2.5% in the second half of this year and reach the 2% target in 2025.
Of course, yeah, we're going to reach all our targets a year and a half from now. And this just becomes a perpetual target. I guarantee you, if this guy is still around in 2025, he's going to be trying to sell you the same spiel. Yeah, I know shit sucks right now, but just wait a year and a half and it's going to get better.
As always, there are risks around our forecast. Inflation could be higher if global tensions escalate, and this boosts energy prices. And
bingo. Now, given the state of the world right now, who is not expecting things to, the global risks to escalate? He's obviously he's obviously talking about war, and yet again, he's trying to cover his ass. So on next meeting, when he has to raise rates, he's going to be like, well, I told you this is based on, global expectations, blah, blah, blah. Again, trying to shift the blame somewhere else. He already knows, and he's perfectly aware that the Bank of Canada is not in a position to cut any rates. Part of the reason is because they're broke. Because of this idiot, Bank of Canada actually has losses. So they don't have any ammunition to cut rates. And he already knows that things in the world are not going well. We're not going to have peace. We're going to have more and more wars. And, he's setting himself up to use that as an excuse, as his next excuse.
Further disrupts international shipping. House prices in Canada could rise faster than expected, and wage growth could remain high relative to productivity.
Now, this is just bloody disgusting. When he talks about wage growth increasing, there is nothing wrong with a person earning more and growing their wages. I think, that should be happening to everyone. We go to school, we increase our skills, and, that's basically what we live for, to increase our wages. He's trying to twist this into somehow trying to say that, those productive people that got raises, they're somehow to blame for the inflation. Again, I can't wait until this guy actually accepts responsibility for what he has done.
On the downside, economic activity globally and in Canada could be weaker than expected, cooling demand and inflation too much.
Could it? Oh, really? You don't say.
We don't want to leave monetary policy this restrictive for longer than we need to. But if we
Oh, you don't want to? So why are you doing it then?
lower our policy rate too early or cut too fast, we could jeopardize the progress we've made bringing inflation down.
There's that boogeyman. It's like, we don't want to cut it too fast because we'll ruin everything. So yeah, the Canadian economy, we need to continue to suffocate it because somehow that's for the greater good. Absolute bullshit from this guy. Absolute bullshit.
So based on our forecast and these risks, Governing Council decided it was appropriate to maintain the policy rate at 5%. Dans l'ensemble,
Makes it sound like a smart decision. Let's listen to the French part. The French part usually contains the best bits, the things that he really doesn't want to say. They usually say that in French.
depuis janvier,
That overall, the data since January have increased our confidence that inflation will continue to come down gradually, even as economic activity strengthens. Our key indicators of inflation have all moved in the right direction.
Those key indicators being the CPI index, to which they keep changing the formula. Great.
And recent data point to a pickup in economic growth. I realize that
What is he talking about? Businesses are at record insolvency rates. People can't pay their credit cards. What planet is this guy living on?
Canadians want to know is when we will lower our policy interest rate.
Yeah, no shit.
What do we need to see to be convinced it's time to cut?
Okay, here it is. Now he's going to describe some unicorns that we need to see and cover his ass for the next meetings. Here we go.
The short answer is we are seeing what we need to see, but we need to see
But we're not cutting rates.
it for longer to be confident that progress toward price stability will be sustained.
How diligent of Tiff Macklem to, stay the course, to be confident.
The further decline we've seen in core inflation is very recent. We need to be assured this is not just a temporary dip.
Yeah, so you can't be assured that you can keep manipulating the formula?
The Governing Council also concluded overall the data since January have increased our confidence that inflation will continue to come down gradually, even as economic activity strengthens. Our key indicators of inflation have all moved in the right direction, and recent data point to a pickup in economic growth. Now, I realize that what most Canadians want to know is when are we going to lower our policy rate? What do we need to see to be convinced to cut? The short answer is we are seeing what we need to see, but we need to see it for longer to be confident that the progress towards price stability will be sustained. The further decline we've seen in inflation is very recent. We need to be assured it's not just a temporary dip. In the months ahead, we will be closely watching the evolution of core inflation. And we will remain focused on the balance between demand and supply in the economy, inflation expectations, wage growth, and corporate pricing behavior as indicators of where inflation is headed. To conclude, we've come a long way in the fight against inflation, and recent
This is him trying to give himself credit for doing something right.
progress is encouraging. We want to see this progress sustained. And with that summary, the Senior Deputy Governor and I will be very pleased to take your questions.
Okay, let's hope we get some good questions.
Go over the ground rules. As usual, we'll start with the reporters we have here in Ottawa at the bank. I'll ask everybody to please limit yourself to one question to maximize our chances of getting to every media outlet. After we go through the room, I will then turn to the phones. If I forget to do so, please state your name and affiliation. Avant de poser une question, veuillez vous identifier. Si je ne l'ai pas fait.
If I haven't done so, and as usual, you can ask your question in the official language of your choice.
Our first question is going to go to Annalise of the Canadian Press.
Morning. Is the door open to a rate cut in June? Is that within the realm of possibilities?
Okay, that is just like such a softball question. Of course, he's going to answer, oh yeah, potentially. We're very data dependent, depending on what happens, but so far we're seeing encouraging signs. I really hope we get some quality, good questions in this question period.
Yes, it's within the realm of possibilities. Look, I think we've been pretty clear. We are encouraged by what we've seen since January. If you look at our indicators, they're not all progressing at the same speed, but they've all been moving in the right direction. Inflation's come down, core inflation's come down. The more timely 3-month measures of core inflation suggest there's downward momentum. Yes, shelter price inflation is still high. There are certainly some things that are still supporting inflation, but things are moving in the right direction. We're encouraged by that progress. We need to see that progress continue. And if things evolve broadly in line with the outlook that we've published today, we will be becoming more confident that we're clearly on a path to 2.
All right. If things evolve with the outlook that they published today, that outlook is so delirious. It's not going to be a surprise things don't go with that outlook.
Inflation, and it will be appropriate to cut our interest rate.
Okay, next we'll turn to Pramit Mukherjee from Thomson Reuters.
Thank you. Just to continue on Najood's question, between now and June, you will have 2 sets of data on the labor market, on CPI, and on GDP. Do you think those data will, and if it continues in the same direction, do you think that data will be sufficient, will give you sufficient evidence and confidence to actually go ahead for a rate cut in June?
Okay, this question, he kind of answered that question in his speech. It's a repeat of the question that was just asked. I don't know what they're trying to accomplish with this. Are these reporters just trying to waste time, pretend like questions are being asked of him? He's going to go through the same huff and puff, and he's going to tell you with this authoritative tone of if everything goes according to our outlook, then we're going to cut rates.
Okay, well, let me expand. Let me take you through a bit more systematically what we've seen since January and what we're looking for in the next several months. So, as I mentioned, if you look across our key indicators of inflation, we have seen progress across those indicators. Some have made more progress than others.
Please leave a comment if you too have seen some positive indicators or progress in the Canadian economy. Please leave a comment.
But they're all moving in the right direction. So let's just walk through them. The economy in the second half of last year, growth was close to zero. Economy
phenomenal, zero, great.
That allowed supply to catch up with demand. In fact, it's more than caught up. The economy's in excess supply. If you look at businesses' short-term expectations of inflation expectations, they've come down. They're running around 3%.
Yeah, businesses just, they suspect they're going to be going out of business.
If you look at corporate pricing behavior, it's continuing to normalize. There's a pretty detailed box 3 that looks at this at a very micro data. We also ask companies what they're planning to do, and fewer companies are planning unusually large or frequent price increases. If you look at households, their perceptions of inflation are coming down. Their short-term expectations of inflation have been pretty slow to come down. But they are moving in the right direction. In the labor market, it was very overheated. It has cooled. We're starting to see some evidence that wage growth is easing. If you look at inflation itself, in the last couple of months, it's come down. Core inflation was running around 3.5. It's now just over 3. Again, if you look at the more timely 3-month measures of core, they're now running below the 12-month measures, suggesting there is.
I really think that the technique they're trying to employ here is, if you keep repeating a lie long enough, then eventually more and more people are going to believe you, or maybe you yourself start believing it. I really think that's what's going on here.
Some downward momentum. If you look at our diffusion indexes, if you look at how broad-based inflation is, it's less widespread. So those things are all moving in the right direction. We're encouraged by this progress, and we want to see that sustained. What is on our mind is that the decline we've seen in momentum is very recent. Wage growth has only just started easing. Inflation.
Yeah, see, that was the problem. Wage growth in the economy was a problem. So, if you got a raise, that's what's causing all the monetary policy problems that this idiot is dealing with.
For households are only coming down very slowly. So, to summarize, I went through the broad range of indicators to really highlight these are the range of things we're looking at. It's not one data point. It's not one number.
No shit.
All this.
Did somebody ever imply that it was only one number? Why does this guy always talk to everyone like they're idiots? Is this like a U of T tradition or something? I don't know. Jordan Peterson is a U of T professor, and yeah, he doesn't talk down to anyone like that. Who the hell is this guy? This guy pretty much is on his way to bankrupting the Bank of England. I don't think he has a right to talk down to anybody.
Evidence coming together, and the message is, look, we are seeing what we hoped and we need to see. We just need to see it for longer to be confident that we are clearly on a path to 2% inflation. And when we are at that point, it will be appropriate to reduce our interest rate.
Okay, I'm going to go to Jordan Gowling from CTV next, please.
Hi, I just want to ask you a bit about the rebound in business investment in Canada in 2024. What's accounting for that? Do you just see that as a blip, or a beginning of a sustained path of investment and more confidence in the Canadian economy?
I'm afraid we have another softball question. Basically, not a question at all, just a chance for Tiff to show off and have a bit more photo ops.
Business investment through the second half of last year was really quite weak. If you look at, for example, Statistics Canada's survey of what companies are planning in terms of their capex, they are certainly planning more. We do think that's going to take a bit of time.
They're actually planning to go out of business. That's what people are planning for.
Materialize. So. Through the first half of the year, we don't think it'll be that strong, but we do think it will be picking up. Overall, if you look at our growth profile for this year, if you look at quarter by quarter GDP growth, roughly about 2% in each quarter, that gives you an annual average of 1.5. If you look at it on a per capita basis, what you see is it starts pretty weak, and as you get further into the year, on a per capita basis, it's picking up. So what that means is that, per households start to spend more over the course of the year.
Yeah, of course they're going to spend more. Prices are going up. Oh, sorry. According to him, prices are under control because the CPI index is under 3%. Yeah, honestly, anybody that goes to the grocery store understands why the individuals per capita are spending more. Stuff costs a lot more. This isn't because, people are splurging on luxury items or anything like that. The bare necessities are costing more. That's why people are spending more.
Companies invest when they're more confident that that investment is going to yield a good return on them. So they want to be assured the demand is there. So over the course of the year, we think that will start to become more apparent.
All right, let's go to Mark Rendell of the Globe and Mail, please.
Thanks for taking my question. The growth forecast for both Q1 of this year and for the full year have been upgraded significantly. It seems like a lot of that is being driven by population growth, but I'm wondering if you can expand a little bit more on what's driving that growth upgrade. How much of it is?
Okay, we're starting to get a hint, maybe just a hint of a difficult question. But of course, like asking this guy about immigration isn't really applicable. Immigration is, it's a federal government policy. The central bank is supposed to be independent. This guy, of course, reports to, Trudeau and company, but in theory, the central bank should be independent, and it's very important that the central bank remain independent. But okay, Globe and Mail, I got to give it to you. So far, it seems like it's the best question we've had.
That population growth picture versus other factors, and if you can kind of unpack a little bit of that.
You're right, Mark, that the main factor is population growth, particularly in the first half of the year. We have revised up our estimate of population growth in the first half of the year. As you get later in the year and into 2025, we've actually revised it down because the government has announced caps on temporary foreign workers or non-permanent residents, which will pull it down. But in the near term, it is higher, and so you got more households, more consumers. That adds to demand. That adds to growth. There are some in the very near term. There are some special factors that are boosting growth. In the first quarter of this year, there was a public sector strike in Quebec at the end of last year. That ended. That will provide kind of a mechanical boost to growth in Q1. There were also a number of other events in the second half of last year, things like the forest fires we all remember. So, just the unwinding of those will boost the first quarter. But you're right. The main thing is working age population is growing faster. There's more consumers. There's more workers. As you get to the second half of the year, population growth starts to slow, but consumption per household starts to pick up. So that when you look at growth on a quarterly basis through the year, we do expect some choppiness in the quarter over the quarters, but if you average them, they average about 2%.
Yeah, so your main takeaway there is, expect inflation to come down, but spending per household to continue to go up.
Thank you for that. Let's go to Greg Quinn from Market News, please.
Good morning. I was wondering about the slight increase to the estimate of the neutral interest rate. Is that any kind of barrier to how fast you can cut interest rates? In other words, is it any kind of a hard floor?
All right. So now we're talking about an interest rate increase for the first time. Thank you, Market Watch. I forget the name of the publication, but okay. It seems like we've got our first good question. If you notice, the whole speech, he was all talking about when are we going to lower rates? Great question. Now he's actually talking about you raised this, you raised this estimate for a rate. Doesn't that contradict all your spiel up until now? And okay, let's hear more of this.
Or a squishy placemat.
Greg, what I would emphasize is that First of all, the neutral rate is not something we can observe directly, and there's a lot of uncertainty about it. We do estimate it, and it's a necessary input in our models, but it's not something that really has much of influence on sort of real-time monetary policy.
Right. Man, there should be a picture of this guy in the dictionary next to the word bullshit. Yeah, so what he's trying to tell you, like, oh yeah, okay, this rate estimate is going up, but don't worry about that. This is, it's absolutely nothing. Why even have that rate?
I mean, in real time, we're much more focused on where's inflation headed, what do we need to do to get inflation back to the 2% target? What do we need to do to maintain it? I mean, the neutral rate is, it's a theoretical concept. It's you want to think about it. The neutral rate is where our policy rate would be in the long run when inflation's at target, the output gap is closed, and there are no shocks. Well, of course, we'll never actually get there. In your forecast in the future, there's no shocks because you can't forecast shocks. But
yeah, this guy can't forecast shocks.
Of course, when we get to the future, there will be shocks. So, yes.
That is the one true thing that Tiff has said so far, right? And I really wish he would incorporate that kind of thinking when they're building out these rosy outlooks, when everything is supposed to be great in 2025 or 2026. Just not right now. Never right now.
It's something we need in our models, and in being fully transparent, we publish the core assumptions underlying our models. That's one of them. We revise it once a year, and with our estimate of U.S. Neutral rate going up, and with some other factors, we have revised up our neutral rate by 25 basis points. It's a range. The range moved up 25 basis points. Is that having a very big impact?
Very important. That range moved up. You see how hesitant he is to talk about it? He keeps trying to shift the blame. Okay, good question. I really have to look up. I'll have to look up the name of who asked the question. Good question.
On our deliberations in real time, no.
Okay, let's go to Mackenzie Gray from Global News next, please.
Hi there. In the NPR, the main upside risk sections for inflation, the number one thing, or at least the first bullet point, was house prices could rise sharply. Can you just kind of take us through the assumption on that? And when it comes to deliberations on potential increased interest rate moves, how much consideration is put into what will happen within the housing market?
Okay, so yeah, this is a softball question. This is exactly what this guy wants to hear. He was alluding to this in his speech, and this is how he's going to try to save face this time. Like, basically, the argument is going to be that if we lower rates, then people are going to run out and spend more they'll qualify for higher mortgages, and they're going to end up buying houses and bid up house prices. So in order to avoid that, this benevolent dipstick is not lowering rates to avoid that mess. It's really playing on a housing crisis that is going on in Canada right now. Rent has shot up, house prices have shot up, so it's playing to that to make it look as if he's doing something for the greater good. Meanwhile, as I've explained, Bank of Canada doesn't have any power whatsoever to lower rates. If they were to lower rate, they would start accruing even more losses really bloody quick. So yeah, okay, let's listen to this question. Answer.
As you point out, we list it as one of the risks. Certainly, we do expect some pickup in house prices. As long as the demand for housing outstrips supply, there'll always be the potential for upward pressure on housing prices. So we have forecast some increase. What we outline in the risk section is that increase could be more than we anticipate, and if that were to happen, that could put sort of pressure on overall inflation. But what I would stress is, it's one of the things that we take into account when we make a policy decision. It doesn't rest on our decisions don't rest on any one indicator. As the governor's outlined, we think about a lot of things.
But this is going to be the one excuse that they're going to be using in a couple of months.
And more than one risk. So it's there. It's one of the risks. It's not the only one.
Okay.
And the thing about housing is, like, when you have inflation, and like real inflation, as in inflation that's measured by, prices on goods going up. So if you go to the grocery store, you get your, your average shopping basket, and you see how much it's increasing. That's inflation. So when inflation happens, the value of money is devalued. Therefore, as your money becomes more worthless, your tangible assets, things like a house, they by definition go up in value. But that's not a case of that's not a case of your house actually going up. It's more of a function of your money getting devalued.
Okay, next I'm going to go to Kevin Carmichael from The Logic, please.
This report and much else that we're seeing.
I think you need to put your mic on, Kevin.
It is on. You not hear me?
Oh, project.
You want me to project? Get all night, stand on my chair too. Question about U.S. productivity, the U.S. productivity boom. Those numbers sort of loom over this report. They loom over much of what we're seeing in the global economy right now. What's your read on how real that boom is? There seems to be debate out there whether this is something that's going to be sustained or a passing phase. What's your take?
Look, it's a very tough question. Just to link it into our own monetary policy report first, we did revise up our estimate of U.S. potential. Most of that actually is higher population growth. Some of it is productivity growth, but we have not taken on board a big permanent shift to higher productivity growth. To be honest, I think in all our countries, the gyrations we've seen in the economy through COVID have created big swings in productivity growth. When you shut down your service sector, that's lower productivity than manufacturing. Mechanically, productivity goes up. I mean, where the U.S. stands out is in Canada, like in most countries, productivity growth coming out of the pandemic has been disappointing. We thought we would see more pickup as supply chains got back to normal, as companies brought on board employees and got new employees and got them trained up. So far, we really haven't seen that.
Oh no, another. I really think like when one of these outlooks that he produces does work out, that's going to be worth a mention, because like so far, he's just an epic fail time and time again. Most famously, when he told Canadians in 2020, with this same smug face that he has right now, that interest rates are going to stay low, and they are low, and they're going to stay low forever. And as soon as he said that, that was followed by the biggest rate increase in history.
In the U.S., productivity went up mechanically in the COVID like everywhere else, and it has stayed higher. There are certainly some things you can point to. You look at the stock market, the large tech companies are doing very well. They tend to be very scalable, very high productivity companies. That might be one reason why U.S. productivity growth has been higher than others. But I think at this point, it's hard to say just how persistent that rise in U.S. productivity growth will be. We have not built in a kind of a big productivity boom in the U.S. in our projection.
But you are expecting, you are basing your projection on U.S. growing. I'm really confused by his answer here. Even in the beginning of the conference, he said that, one of the reasons why they're expecting growth in Canada is because they're expecting growth in the United States being a trading partner. This kind of contradicts what he says, but it's no surprise to hear contradictory stuff from Tiff Macklem.
Okay, we've got a couple more questions here in the room. Next, I'm going to call on Paul Vieira of the Wall Street Journal, please.
Was there any talk among officials about cutting rates today?
Paul, we did discuss when to reduce our policy interest rate. There was a clear consensus to hold the policy rate at 5%. As I've indicated, we were encouraged by the progress we've seen since January, and we agreed that what we wanted to see this progress sustained. We wanted more time to be confident that this progress would be durable. We also agreed it would be appropriate to cut the policy interest rate when we're confident that we're clearly on a path to the 2% inflation target. Now, as you might expect, we're a council of 6 different people, and so there is some diversity of views about how close we are, and when we're going to see what we're looking for. I would just say, I think that's why you have a council. You want some diversity of views. That's healthy, and we're having a good discussion. For the decision today, there was a clear consensus to hold at 5%.
Okay, so basically nobody is really talking about rate cuts. They're talking about potential maybe rate cuts down the line. So far, no one's even talking about it.
Okay, and I'm going to go
And you
now.
will be getting the summary of deliberations in a couple of weeks we will expand.
Sorry about that, Governor. We'll go now to Randy the Dong Knight from Bloomberg, please.
How worried are you about relatively weaker loonie restoking inflationary pressures?
Look,
Good question, Bloomberg.
in Canada, that allows us to gear monetary policy to what's going on in Canada. And overall, the Canadian dollar's been really reasonably stable. If the Canadian dollar does move, that's something we'll take into account in terms of our outlook. It will affect, a weaker Canadian dollar will tend to make our exports more competitive. We'll tend to have more strength in exports.
But it's going to make a lot of your prices go up.
There will be some direct pass-through through imported goods. Those are things we take into account. But look, the flexible exchange rate, it's what allows us to run a monetary policy in Canada geared to what we need in Canada, and we will be, we're gearing our monetary policy to where we think inflation's headed in Canada.
So basically a non-answer.
We're going to go to the reporters who have joined remotely now. I'll just remind you on the line to come off mute only to ask your question, and then please go back on mute as soon as you finish so that everybody can hear the response. I'm going to start with John Ehrlichman from BNN Bloomberg, and then go to Alicia Skierska from Yahoo and Max Sato of Mace News. So John, first question to you, please.
Thanks so much. And Governor, on commodity prices, which we're watching very closely right now, can you just give us your current assessment on what you're going to be watching on the inflationary front from that perspective?
Well, I guess a couple things on commodity prices. One, you have to look at commodity prices through 2 lenses. Certainly, global oil prices have a very direct impact on things like gasoline prices, and that has a very direct and immediate impact on total CPI inflation.
Really? Gas prices have gone up quite a bit, and he's saying inflation is nearing his 2% target. Yet another contradiction brought to you by Tiff Macklem.
Gas prices tend to go up and down, so that's one reason why
I mostly see them go up, though.
We're particularly focused on core inflation. And if you look at the near term, we know gasoline prices have gone up. That's why we think total CPI inflation.
He's really observant. He knows the gas prices have gone up.
Is likely to stay around 3% in months ahead. What we're going to be particularly focused on is core inflation. We do think there will be further gradual easing in core inflation. And when we talk about the progress we've seen recently being sustained, that's what we mean. Or certainly that's an important element of what we're looking for. The other element of commodity prices, of course, is Canada is an important commodity producer. We export a lot of commodities to the world, so higher commodity prices, the more income tends to come into Canada. So
Right. Everything about that is true, except for that small detail of our idiot government and climate change plans that are constricting those very resource-based businesses that he's talking about.
It also affects demand. So we're looking at both those dimensions.
Okay, the next question is Alicia Sikirska from Yahoo Finance, please.
Thanks, Governor, for taking our questions. Given that there will be a new federal budget before the next rate decision, we've already seen some new spending.
Okay, we got cut off there. And I guess, yeah, I guess that's it, folks. That's all we got for today.